For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Thank you very much. This is Managing Your Financial Future. Johnny Dean, your podcast host, Professor Rick Plum, certified financial planner, professional, accredited wealth management advisor, and as I said a couple episodes ago, all-around good guy, AAGG.
Thank you.
Yes, of course. Yeah, we've given you that designation. I'm going to ask a question of everybody right off the bat here, because today's topic can go 100 different ways, and we're going to try to keep this focused. But let me ask you this question for the folks listening. If your portfolio... if your investment portfolio goes down, does that mean that your investment plan or financial plan is somehow broken? Is there something wrong with what you're doing? Now, if you look around, most financial models, and I think many financial advisors, treat risk and market volatility as essentially the same thing. But I would say that if you've ever lived through a bear market, especially in retirement, you probably know better. Now, here's another question, too. If the stock market dropped, say, 15% tomorrow, would that be volatility or would that be risk? Now, the person's answer to that question will probably dictate how they structure their financial plan. And this is kind of what we're going to be discussing today. You know, Professor Plum, it's been said by some wise people that volatility is not the same thing as risk. It's just a reminder that risk exists. Now,
I like that.
Yeah. Volatility, somebody also said, volatility is temporary and emotional. It tests your patience. Risk is permanent and financial. It can derail your future. Now, is that a fair assessment? That's question one for you. And question two, why is this important for our podcast listeners to know?
Well, I think it is a fair assessment. I like the way they've put it. And the idea, if volatility is risk, and we are trying to not accept any risk, then we are also never going to be able to get a better than CD rate of return on something. Mm-hmm. Because the only way to get a true stock market return over time is to be in the stock market. And the only way, there are some fixed index products that can try to mimic that. They won't give you the whole thing. And there are some structured notes that do a pretty good job too. So those are one-offs. But in general, you have to be able to accept volatility to get those better rates of return. And so your question of if the market went down by 15%, I look at it from two different ways. Is that a wrong approach? Is that risk? It's risk if you need to spend that money tomorrow. That is risk. You have just accepted a ton of risk, and you got screwed by it because the market went down and you needed the money. Now you got to spend. You have to sell, 18% more value than you wanted to begin with. On the other hand, you need to identify that volatility. If I'm an investor, that is not risk. That is just a day in the life of my portfolio, and I'm looking to buy in. Mm-hmm. This is an opportunity. If it truly is risk, then it can't be an opportunity. But the reality is when the market goes down, that's an opportunity, assuming I am a longer-term investor. If I'm a short-term investor, and just because you're 80 years old doesn't mean you are a short-term investor with all of your money. It just means you're potentially a short-term investor with some of your money. So if my portfolio goes down by 15%, but it's part of the portfolio I don't need to touch for a while, 10 years or more, then that's volatility. That's not risk. Risk is that permanent issue that I have to sell something when the volatility is negative, and I have to sell it, and I turn that volatility into a permanent loss by selling something when it's down.
Volatility is price fluctuations is really what it is, the up and down. But
volatility is a fact of life.
Right, but real risk is something much more personal and permanent. Real risk is things like running out of money. It's losing your job, having to sell in a downturn. It's not reaching your goals. I think real risk is what actually hurts, and it's not what just bounces around on a chart.
Volatility, we cannot control. Volatility, we have no say over. Volatility is going to happen. Sometimes volatility is positive too. We like that. But there's that negative side to it, that volatility is not something we have any kind of control over. Risk, on the other hand, is something we have control over. So volatility is something that we can protect against, or we can use to our advantage if we know what we're doing. Risk is something we have to identify and control. Now, a lot of the idea that these balanced portfolios in retirement and just taking a systematic withdrawal are basically stemming from what is now considered to be somewhat outdated, the modern portfolio theory that came around in the 50s. Mr. Markowitz put this together and said that diversification and diversifying into negative correlating or low correlating different assets is the driving force behind your return. You're either going to develop your portfolio to minimize risk based on a certain rate of return, or to maximize return based on a certain amount of risk. Now, he's putting the two terms of risk and volatility backwards, in my opinion. But so the idea is that you can try to reduce the volatility of the portfolio through diversification. And this is true, but it's all geared around a portfolio that is not distributing money. It's just designed around a portfolio that has time to do what it's supposed to do, because we can't control the total amount of volatility that he's accepting in these. We can control the assumed amount of volatility based on time horizons in the market, and short-term time horizons in the market, we can't accept volatility at all, because if we do that, then we are introducing the potential for risk.
So in other words, it works, this whole old idea of modern portfolio theory works in the accumulation phase. In other words, be diversified to a degree.
But be diversified. Now, people have taken, just like anything else, people take something that makes sense and run with it until it doesn't make sense. They overuse it. Diversification is an important issue, but there's also something that becomes over-diversification, where you're so diversified that there's no way to – you've got everything. You're never going to beat the market. You're just going to get a watered-down return. And also diversification has to do with investments, individual securities between stocks and individual security classes, between stocks, bonds, cash, alternatives, real estate, other things, commodities and all that. That's diversification. I mean,
well, okay. Let's talk for a moment about why people need to know this. I mean, and I think this all ties in with the idea that when you mentioned this modern portfolio theory back in the 50s, the idea, of course, was that you set a certain percentage, 50-50, 60-40 stocks and bonds, whatever it is. And you when you get out of line with that, your stocks grow or whatever.
You rebalance back.
You rebalance back, and you continually do that throughout retirement. Now, I think there's a problem with that. Do you want to explain why we believe there's a problem with that, and why we don't care so much for the whole rebalance modern portfolio theory thing?
Well, I'm not a big fan of systematic rebalancing, especially the more often. I mean, they talk about doing it monthly, doing it quarterly. Markets tend to run longer than that. And so if the markets are going up, it's systematic rebalancing. We say, so if I've decided that 60-40, whatever stock bond mix is supposed to be what I'm going to be doing, and I'm actually managing to that. If I'm 60% stocks and 40% bonds, and the market is on a tear, then after a month, I may be 65-35. With systematic rebalancing, I'm going to sell that 5% in stocks and move it over to bonds. So I'm going to continually sell on the upside, which is not bad, but I never give it enough legs to let it really move. And then, so I think it happens too much. I think you're hurting yourself. And studies have backed me up on this, where it says systematic rebalancing you're cutting your legs off too quickly. You're selling too quickly. You're not giving enough time for it to move. Markets move in longer movements than that. Yes, it's going to drop at times, but you want to stay with it long enough until you're overall quite a ways out of balance. And then say, okay, but I think before that, this is what I don't like about the 60-40. I don't like the idea that my portfolio is just straight 60-40 and it's always going to be 60-40, because that's assuming I need that 40% to temper the volatility of the 60. But that's not the way you should manage a portfolio.
Well, yeah, and see, this is where buckets, I think, differs from this standard, systematic withdrawal, rebalance, stay in balance. And, this also goes back to the idea that, well, the older you are, the riskier stocks are. Stocks are risks, so it poses a whole lot more risk to your portfolio. But if you look at a bucket strategy, which, of course, we've talked about many times on this particular program because we like it. If you look at a bucket strategy, properly done, you're going to be way out of balance, potentially. You're going to be heavy on stock toward the end of, say, a 15-year period, and much lighter on the fixed side.
Right, and you're going to be lighter on the stock side when you start retirement than you are when you're older, which some people say goes against the grain. But, I mean, this all comes down to the idea that you need to be in a specific balance to control the volatility, or to control the fact that you don't want to turn volatility into risk. But if you've taken this all into consideration ahead of time, you know where you're supposed to be, you know what's happening, and we're doing not systematic rebalancing, but value averaging. We're taking advantage of it when it's out of whack, but not just systematic. So this whole idea of this balanced portfolio, we're talking about this as if that's the right way to do a portfolio in the first place. It's not the right way to do a portfolio in the first place. It's not the right way to manage a portfolio, even in the accumulation phase, as you get closer to your goal years. It's modern portfolio theory when you're 20. You're probably too diversified. You need to go a little bit more aggressive and go all stock and stay all stock for a while. But as you get closer to your retirement age, or to the age where you need to spend this money, maybe we're talking about a college fund for somebody who's getting closer to college age. And so when we're getting closer to that spending age, do we just pull back the portfolio and our contributions going forward? And so we go from 100% stocks to 90%, 80%, 60%, whatever, as we get closer to retirement. But the idea is that you could just use that one portfolio for everything, and you continue to invest your money in that portfolio 60-40 mix, 50-50, 70-30, whatever it is. That's wrong too. Even in the accumulation stage, that's wrong. That is just, you're just, again, cutting yourself off of the legs, because you're not using the one thing that we know that can help us over time. We're not using volatility to our advantage when we're doing that, because if I'm putting 60-40, if I have a 60-40 portfolio and I'm putting my 401k money into that portfolio, 40% of my money is not taking advantage of dollar cost averaging. I should be identifying that I should be going all stocks, which means I'm blowing the 60-40 out every time I put money into it.
Well, this is, boy, you hit it right on the head here. And I want to make sure people are understanding what we're saying. And what you said, of course, is if you're 20 years old and you've got a portfolio that's 60% stock, 40% bond, well, you got 40 years or more.
You're wrong on your portfolio is what you
are.
Because
you should be taking advantage of the all stock. You got plenty of time. And the whole idea here is that volatility can actually be your ally if you let it. Now, the reason we expect higher returns from stocks is because they're volatile. If they weren't volatile, they wouldn't offer this, premium that they give you over the long term. Now, I think that the thing that people fear, this volatility, is actually what makes long-term wealth building possible. If you avoid it too aggressively, like you go all CDs or all bonds or whatever, you could be protected from volatility, but it also increases the risk of not growing your money fast enough. So avoiding volatility may feel safe, but it can actually make your plan riskier in the long run. Is that what you're saying?
I'm saying that volatility, as I said earlier, is a fact of life. So we need to either protect ourselves from that, protect ourselves from turning volatility into risk, or find a way to use it to our advantage. And you can use it to your advantage by giving yourself time, by dollar cost averaging, and by not freaking out when the market goes through the negative volatility. You can't have positive volatility without negative volatility. You can't be ahead of expected return without accepting the fact that at some point you're going to be behind expected return, because otherwise expected return is just going to be a flat number, and you can't have that and get better than CD inflation type rates of return. So when we're building a portfolio, you have to learn how to use that volatility to your advantage without accepting the risk of having to sell when it's down. When you get towards retirement and you get into retirement, unless you're 105 years old, you still need to send some money ahead for a couple of years. I mean, even if you're 80 years old, there's a good chance you can live 10 or 15 more years. So do you want, and so let's say that you want that, $50,000 a year, and you've got $1 million portfolio. Well, okay, you put 500,000 of it into something with no volatility, CDs, treasuries, things of that nature, laddered out, and you've got your 50,000 a year plus the earnings for the next 10 years. That puts you out to be a little bit older. Yeah. And the reality is, the other 500,000 you're probably never going to use. You're investing that for your heirs. Now, on the other side, if you're 85 years old, your heirs are probably late 50s, 60s, so they're getting ready to retire too. So if they're looking at your money as their money, well, it's still their long-term money. Well, invest it the right way. Invest for growth when you've got the time horizon.
Okay, so our stocks, I'm going to ask you a question here that, because we only have a limited amount of time, obviously, but a question that I know the answer you're going to give me. Here's the question. Are stocks inherently risky, Rick Plum?
Stocks are inherently volatile. That does not mean risk. So if I'm the parent of a 17-year-old and I've got the money set aside for their first year's college tuition, that for next year, whether it's $5,500 or $50,000, depending on where they're going to school, and I have that in the stock market, I am asking for risk. I am asking to turn volatility into risk. I'm betting. I'm going to Vegas on this one. I'm betting that the market's up. That's a 50-50 bet, or 60-40 bet. It's not a good bet necessarily. And if you're like me and Murphy's Law rules your life, that's a horrible bet, because the more I need it to be available next year, the more likely the market's down at that time. So, turning volatility into risk is not a good idea. On the other hand, if I've got time, volatility is not risk. Volatility is the way to go. The only question is, if I've got that $50,000 and my kids are 4 years old, do I want to invest it all today? I have a 14-year potential time horizon, unless they're geniuses and they're going to go to college like Doogie Howser when they're 8. And if that's the case, they're probably getting scholarships anyway. So I've got time for the market. Do I put the $50,000 in all at once, or do I put the $50,000 in over a specific period of time? And I'll tell you that dollar cost averaging, Murphy's Law tells me that if I put it in all at once, the market will go down tomorrow. If I put it in $5,000 a month for the next however many months,
it's going to go up.
The market's just going to go up for those whole time until I get it fully invested. Then it'll go down. That's just Murphy's Law.
Well, so
but I still have 13, 14 more years for it to recover. What do I care? Volatility is a fact of life. How we treat it, and almost more importantly, how we react to it, is what potentially introduces risk into the equation.
Anybody who isn't aware of this fact about volatility and risk might look at a bucket strategy portfolio, and in a basic portfolio, you're setting aside a certain amount to spend for the next 7 years. You're setting non-volatile assets there. You have for the next 7 to 8 years, not volatile assets. They may be little volatility here and there, but nothing that time can't overcome. And so after 15 years, if you just spent all of bucket one down, you spent all of, bucket two, you refilled it to bucket one, you spent that down. I mean, you are going to be left, and we don't do it this way, but if you could. you would be left after 15 years with almost 100% stock at that point. Now, somebody would look at that who doesn't understand and say, man, it's been 15 years, you're 80 and you're 100% stock. What's wrong with you? That's too much risk. What do you say to that?
Well, there have been studies that show that even if you do that you're still in a decent enough shape because you've let the portfolio grow enough that even the dividends off that would be enough to satisfy the potential need for what you started with, whether it was 4% or whatever. But on the other side, as you mentioned, we typically do not like to let it go that long. We're always, remember I said volatility is something to protect against, but also something to use to your advantage and take opportunity from. Either opportunity, negative volatility allows us to buy potentially when the market's low. That excessive positive volatility that happens from time to time, those are selling. So the idea is to not use systematic rebalancing, but use value averaging as a rebalancing tool when we're way ahead of where we expected to be over a period of time. Not necessarily 15 years, but just because we set it up to give you 15 years doesn't mean the market's going to crash tomorrow. We're setting it up so that if the market does crash tomorrow, you're going to be okay. But that doesn't mean that it's going to crash tomorrow. What if the market, like 2018 was a bad year. 2019 was good. 2021 or 2020 was actually a decent year in the market if you didn't sell in the middle of the pandemic, complete craziness. 2021 was a great year. So you had 3 years of really good returns. Now, if you were selling at the end of each of those years, and then 2022 came around when the market was down 20%, you had money to buy in. So if you're using the better than expected return to value average, so you're not going to let yourself necessarily go to 100% stocks because you're going to take advantage of those better than expected returns. And you're looking to refill bucket number one when it's appropriate.
I'm sorry. Can you explain very quickly, in very quick terms, the difference really between rebalancing and value averaging? I think some people.
Well, they are the same in some respects. Value averaging is looking at what your expected return for your portfolio, your specific investments. I have, $300,000 out of my $1 million in bucket number 3, pure stocks. I expect that stock portfolio to do 10% a year. Just make it easy math. So at the end of the first year, I expect that 300, because I'm not adding to it. I'm actually taking the money away from bucket number 1. I'm not taking money away from bucket number 3. So I expect a 10% that 300,000 should be 330,000 after the first year. Maybe it's 335,000. I'm not too, it's not way over 10. It's right about 10. The next year, I expect it to be $363,000. But maybe it had a really good year that way, and I'm at the $400,000. I'm way ahead of where I thought I would be. I'm, $40,000 over, $37,000 over where I thought I'd be. The idea would be, I'm way ahead. Should I take some of that $40,000 and maybe refill bucket number 1 a little bit, stretch out my time horizon a little bit? Now, I am not saying that is the top of the market. I'm saying we're way ahead of where we thought we would be. Let's see what we can do with that. Let's not take it back down to 300, but let's take that excess return. And when that excess return becomes bigger and bigger and bigger, then you really want to start more seriously consider value averaging, because anytime the market goes up and up and up and up and up and up for significantly number of years, you're asking for it to come down.
What would be a takeaway for people who, because I know we're talking about some concepts here. We're talking about value averaging, rebalancing, and modern portfolio theory, and all this stuff that's kind of ethereal. What is a takeaway? What's a takeaway for somebody who says, well, look, okay, now I get it. Okay, volatility can be your friend, and it's not risk. But what is it that people really need to be aware of, and why we're talking about this today?
Well, you need to be aware of the fact that volatility is a fact of life, and you don't want it to be risk. And that tells us that we need to have a strategy that incorporates the idea of volatility, being able to protect against it where it can hurt us in the short term, and allowing volatility to help us where it can help us in the long term. Have a strategy that identifies it so that when it happens, and it will happen, you know what to expect from it. You know when the market's down, you know not to freak out. And if you have some extra cash on the side somewhere, some dry powder, it might be a buying opportunity. Not an automatic buying opportunity, but it might be. On the other hand, when the market's doing better than expected, which it might do, don't get totally greedy over it and go all in. Let's understand. But having a strategy that identifies what the investment is expected to do and managing to expectations and not expecting a volatile portfolio to be able to take a distribution from every year on a stable issue from a volatile asset. That's just ludicrous. But using the idea, and I look at this for people saving for retirement too. You don't waste good, and volatility can be good. But if you're using a target date and you're within 10 years of your target, you're wasting good. You're being too conservative because that target date is probably 70% stock, 30% bonds, and you don't want to be dollar cost averaging into the bonds. So, use what's there to your advantage. Don't use it when it's not helping you or it could actually hinder you. But that requires a strategy.
A strategy. Any particular strategy in mind?
Time is our greatest friend and our greatest ally and our biggest enemy. Learn to understand it. So, time segment. Match your assets to your liabilities. Understand where the risk or where the volatility is coming from, and is the volatility a friend or a foe, and use it for both. If it's a foe, don't play its game. If it's a friend, use it for all it's worth. Bottom line is it comes down to a bucket strategy. And bucket strategies come into play at any age. If you're 20 years old, guess what? You have a bucket strategy. You have assets that are creating the income that you need to live on, and you're trying to save assets for the future. Guess what? That asset that's giving you the income to live today, you are that asset. You are your best investment asset because you're the one making the money, you're covering your needs, and you're creating bucket number 3. So that tells you you're all bucket number 3 all the time until you get closer to when you might want to spend the money from that portfolio. And don't tell me tomorrow, yes, we need an emergency fund. How you treat an emergency fund depends on the individual. I've mentioned before, some people look at an emergency fund as long as I've got empty credit cards, I have my emergency fund. I don't need to keep $50,000 in cash. And then as you get older, I'll tell you that it.
We're in a different perspective now, right? Yeah, we would have been maybe different advice 35 years ago or something.
Yeah, I was telling somebody about. I've known people that if they have money or an empty credit card, they have their emergency fund. And I've known people that can't sleep at night unless they have $50,000, $100,000 in cash, whatever the number is that they feel comfortable with. And you know why I know these people? Because they are me at different times in my life.
That's what experience does for you. It gives you a whole different perspectives. We could go on about this forever, and that's what I said at the top. I said this could go 100 different ways, and we're going to have to try to encapsulate it into a podcast episode. But the whole point of this is that you need to know the difference between risk and volatility, and understand that volatility can be your friend if you allow it to do so. And it all comes down to having the right strategy, and the bucket strategy is designed to give you some measure of, a way to potentially use the volatility to your advantage. And I think that's
designed to protect you against that volatility in the short run, and it's designed to utilize that volatility to your advantage for the long term.
I like it. That's a good sentence to use right there. If you want to know more about this stuff, you can contact Professor Rick Plum or any of the Lucia Capital Group advisors. Their phone number, 800-644-1150, 800-644-1150. They've done a couple of bucket strategies over the years.
Only over the last 30-some years.
Yeah, but
We've been doing it a long time.
Yeah, but were you doing it, 55, 60 years ago? I don't think so. So it's
55, 60 years ago, I was still riding my Schwinn bicycle.
That's right, without a helmet, right? I remember those days.
Oh yeah.
Heck, yeah.
Many times without shoes.
But we don't take this kind of risk. There's some risk for you right there. We don't We don't take those risks anymore. And
I still ride a bicycle, but now I wear a helmet.
That's right. There's that age thing showing. If you
Hey,
need,
everybody wears helmets now.
of course,
I mean,
you should.
3, 4, 5-year-old kids, they wear helmets. 10-year-old kids, I see the kids riding around the neighborhood, and every kid has a helmet. And that was something we just didn't see when we were younger. We just didn't know.
Well, we didn't know.
We've learned, just like we've learned how to use buckets to an advantage. We've learned how to use helmets to our advantage.
See, it's there in case you need it. 800-644-1150. Talk about this stuff with a Lucia Capital Group advisor. And, man, we got a lot of stuff online. You can read about this. We have a whole pamphlet, brochure, whatever you want to call it, guide on the bucket strategy. Go to the luciacap.com website and download it. Just type in bucket strategy in the search bar up in the upper right corner. You can download it for free and read all about the bucket strategy, luciacap.com. Don't forget to subscribe to this podcast. As I keep telling you, what if you hadn't subscribed and you missed this whole episode? Wouldn't you just feel awful? It's about regret. Don't do that. Subscribe to this podcast, Managing Your Financial Future, Apple Podcasts, Spotify. That's the best place to do it, and listen to every single episode. You don't want to miss anything at all. I think we covered it, Professor Plum. I do believe we could have gone a whole bunch of other ways, but
we scratched the surface, but we got a little bit of it across.
Well, we did. And if you have any questions on this, you can certainly ask us, and we'll be happy to address it in a future episode. We are out of time. My thanks to Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. For him and the rest of the gang, I'm your podcast host, Johnny Dean. This is Managing Your Financial Future. Thanks for listening. Talk to you again next week.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. The economic forecast set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. Stock investing includes risk, including fluctuating prices and loss of principal. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. A value averaging strategy or a dollar cost averaging strategy do not guarantee profit or protection from loss. You must consider your willingness to continue purchasing during periods of high or low price levels. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Structured notes are considered complex investment products. They contain unique features, risks, terms, conditions, and fees, charges, and expenses. Fixed index products are complex long-term investments designed for retirement purposes. Guarantees are based on the claims paying ability of the issuer, subject to their terms and conditions. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial.